Few things in this world juice business results both up and down more than leverage, and most people will be pretty familiar with plain old financial leverage, that is borrowing money to invest in a business or in real estate, but far fewer people spend time thinking about operating leverage. That is the effect by which businesses can become significantly more or less profitable with comparatively small changes in their revenue. In this video, I want to compare two companies, both in the media space, that have had very different business results over the past 10 years. One has grown its revenue more than 7 times in the past decade, and as we'll get to in this video, has had substantially greater increases in their profitability, and the other business has experienced about a 12 or 13% decline in their revenue, and again, as we'll get to in this video, a substantially greater decline in their operating income. But before we get into that, we do have a sponsor for today's video, and this video is sponsored by ShareSite. ShareSite is the portfolio tracking and recording software that I've been using for several years at this point, and that you may have seen featured here on the channel in the Shameless Cloner Portfolio series. We are well and truly into tax time here in New Zealand and Australia and many other parts of the world, and ShareSite is the tool that I use for tracking my portfolio and the returns I'm getting from capital gains, dividends, and currency fluctuations, as well as the tool that I use to do my tax reporting each and every financial year. It integrates with the brokers that I use, so it automatically pulls in any buy or sell transactions that I have in my portfolio, and it really does make tax time in particular a lot simpler than it would be otherwise. It generates a few simple reports that I can ship off to my accountant, and that is more or less tax time done from my share portfolio perspective. There is a free version of ShareSite you can use forever where you can track up to 10 stock holdings, but if you want to check out the full version of ShareSite and have more than 10 holdings and get access to more premium features, head to the link sharesight.com/investingwithtom. That will be the first link in the description, and that will get you 4 months free off of an annual subscription to ShareSite. Thanks to ShareSite again for sponsoring the video. They've been long-time partners here on the channel, and thank you to those who have used that link to sign up to ShareSite. It directly supports me, so I really do appreciate that. So the two companies we'll be comparing in this video, firstly are Netflix, which is a company that I would say pretty well everyone watching this video will be quite familiar with, and secondly SkyTV, which is a New Zealand-based media business, which I'm assuming my New Zealand subscribers will be mostly familiar with. For those watching from outside of New Zealand, I will explain the business model a little bit more in a sec. Now this video isn't intended to be any sort of comment or recommendation on the stocks of either of these two companies. Rather, they are two businesses in a very similar industry. They are direct competitors in a way, and they're businesses that have had very different results over the past decade, and it's quite an interesting case study to dig into to understand some of the core characteristics of businesses in this space. Now firstly, let's talk about the business models. Of course, Netflix is the world's largest and most successful streaming service. They have grown a lot in the past decade, and their business model for a long time and still to a significant extent is licensing content from other studios, both in the US and also outside of the United States as well. They license content from studios that have created that content, and they put it on the Netflix platform for their subscribers to stream. But increasingly, Netflix has also focused on creating Netflix original content, which they're producing in their own studios, and they obviously have a lot more control over how much they spend and what the end product actually looks like for their subscribers. Netflix is the overwhelming winner in terms of subscribers in streaming in the US and also globally. They also, with a few smaller exceptions, charge the highest price out of many of the major streaming businesses as well. And over the past 10 years, they have grown from 34 million subscribers in 2013 to over 230 million subscribers today. And the second business, SkyTV, is a paid satellite TV provider here in New Zealand. In New Zealand, if you want to watch TV, we have a small number of free-to-air channels, but if you want to get access to the latest movies or sport or the Disney Channel or Nickelodeon or Discovery or MTV or National Geographic or anything like that, SkyTV for a long time has basically been the go-to provider of that type of content. Now keep in mind that New Zealand is a relatively small country of about 5 million people now, but back in 2013, Sky had 856,000 subscribers here in New Zealand. And on average, they generated a massive $1,034 of revenue per subscriber per year, which is about $86 per customer per month. Now, following a decade of competition from the likes of streaming services like Netflix, and also after the loss of certain broadcasting rights to major sports events, SkyTV's core product, sort of their Skybox product, has been on a steady decline over the years. Now, the way that SkyTV structures their business has changed over time. They still have their core Skybox subscribers. That number of subscribers has fallen from that 800,000 or so to about 517,000. But like I say, they've changed their business structure a little bit, so they have an additional 506,000 streaming customers now as well. But importantly, the amount of revenue they generate per customer has fallen quite significantly. It's fallen about 30% in the past decade to about $740 a year, or about $62 per month. Now, to me, the most interesting comparison with the likes of Netflix and SkyTV isn't necessarily that streaming has grown faster than more traditional forms of media or anything like that, but rather it's about the flow-on effects to the profitability of these two different companies. And that is where this sort of lesson in operating leverage kind of comes into the picture. Now, operating leverage is simply the idea that when you have a given increase in revenue, say a 10% increase in revenue, you can have a substantially greater increase in your operating income and in your earnings. And that's basically because you have the option to spread your fixed costs within a business over a larger number of customers and over a greater amount of revenue. And operating leverage is a fantastic thing when a business is growing, but it's a terrible thing when a business is shrinking. And Netflix and SkyTV, again, are pretty good examples of that. Now, for both of these businesses, they have relatively fixed costs. And again, for both of these companies, a lot of their major expenses simply go towards content. In the case of Netflix, that's a mix of licensing and original content. In SkyTV, it's much more licensing than original. But nonetheless, they actually have pretty similar kind of cost structures in that area. For Netflix, they have what they call additions to content assets spend of $17 billion last year. That's about 53% of their revenue. SkyTV have their sort of equivalent to that, which they categorize as programming costs, which represented almost exactly 50% of their revenue in FY22. About 50% of their revenue got spent on those programming costs. And of course, for both of them, that content spend is sort of a necessary evil. If you have no content to show your subscribers, you eventually end up having no subscribers. But the beauty of this model, if you can grow, which Netflix certainly has grown their revenue a lot over the past decade, is that for any given show, you only have to spend the money to create the show once. You don't have to recreate it for every new subscriber that comes in the door. Doesn't really matter if 10 people watch it or if 100 million people watch it. You only have to spend the money to create the show once. So every additional subscriber that Netflix can add to their platform, call it $15 a month for a North American subscriber, ends up being pretty close to $15 of additional operating income for the business. And over time, that has been a beautiful thing for Netflix. On the screen here, you'll see that over the past decade, Netflix have grown their revenue about 7 times, yet its operating income has grown over 25 times, and their operating margin has gone from about 5% to almost 18%. That's a result of more subscribers in general, charging more per subscriber, and lowering your costs per subscriber. Even though Netflix has spent more money over time on the likes of content, their number of subscribers has grown even faster. So the per subscriber costs have trended down and down over time. Next, let's compare that to SkyTV, where unfortunately we have a lot of the exact opposite things starting to happen. Now, SkyTV have added quite a number of streaming customers, but unfortunately their Skybox, sort of more traditional customers, have trended down. And the key here is that their revenue per customer has also trended down. And much like Netflix, where you have an additional dollar of revenue being pretty close to an additional dollar of operating income, it works kind of the same way in reverse for SkyTV. If you lose $1 of revenue from losing a subscriber, you lose not a full dollar, but probably pretty close to it in operating income. And instead of being able to dilute your costs over a larger customer base, you end up concentrating them in a smaller customer base. And this is what that's looked like in terms of business results for SkyTV over time. In the past decade, revenue is down about 13%, but operating income is down about 64%. And that is that kind of operating leverage in the unfortunate and painful direction really started to kick in. And all of that is actually despite Sky being pretty successful in reducing some of their absolute operating expenses over the past decade. In the past 10 years, operating margin has fallen from a fat 25% in 2013, a phenomenal business at that time, down to a more slender 10% in the 2022 financial year. So what can we learn here? Well, firstly, just like financial leverage, operating leverage in a business model can either be your best friend or your worst enemy. And again, just like financial leverage and like debt, you also have to be cautious when you're getting involved in a business that has a lot of operating leverage, particularly if it's a business that's shrinking. If you are getting into a business that is shrinking and does have operating leverage kind of inherent in its business model, like we looked at with SkyTV today, that's not to say that that's guaranteed to be a terrible investment, but you want to make sure that you're being more than compensated for that characteristic in the price, because earnings can really fall quite aggressively if you're not careful. If you do get into one of those situations, you want to be really careful to check that you're not underestimating the amount that earnings can fall, even with a pretty modest decline in revenue. And finally, it's not really a point I've spent too much time on in this video, but I would also say to be cautious of any business where revenue can fluctuate wildly from year to year, but where your fixed costs are just that, are very fixed, and you can struggle to get expenses out of the business in really poor years. Again, that's not to say things like commodity companies, for example, can't be good investments, but they are prime candidates often cases for wild swings in earnings because of these operating leverage type characteristics. So that's really all I've got for this video. If you did enjoy it, please be sure to subscribe to the channel if you haven't done so already. And if you're interested in checking out ShareSite, again, that will be linked down in the description below. But that's it from me for this one, and I'll see you on the next video. Cheers.